Welcome back to the Dojo, everyone. I am Sensei Kevlar. Previously, we have been studying how to use our indicators to build signals which tell us how to be profitable in this market by making a strategy which has us planning for every opportunity that we want to create for ourselves. We do that by using allocation in order to ensure that we can always make the right move, and strategies that ensure that no matter which direction the market goes, we have a move to make. You combine those two, and you get a no-loss strategy. Now, what I've taught you in the past is that you want to be able to do 6 different things at the same time, 10 different things at the same time, 15, 20, 30 different things at the same time. Allocate, double cost average, look at your indicators, find your support and resistance, trend lines, MACD, Williams, scheduling, allocation, distribution, both price and time. The list gets long at some point. Prior to now, I've shown you the mindset of automation, which is to break down your strategy. And that was really why I wanted you to think through that. I wanted you to think through what it meant to have a strategy. Having a strategy meant having indicators, which were generating signals. And those signals were informing the strategy. So let's just review that really quick before we move on. The indicator is the RSI. The signal is the RSI goes above 70 and then below 70. The strategy is when the RSI goes above 70 and then below 70, we sell. The plan is that when the RSI goes above 70 and then below 70, we sell how much? How often? Same thing on the downside. We buy how much? How often? Okay. Previously, we have been very much working at the plan level and then working backwards into the strategy. Then what I did is I showed you how to automate more of that strategy. Today, what I want to do is I want to show you how to take the application of what you learned with regards to automating that strategy and applying it to your plan. Because doing this can get a little bit repetitive after a while. And if I could figure out where, there we go, figure out how to make this thing come up, that would be great. You can, if you can automate your strategy to the degree that you can automate your strategy, this will save you time. RSI, MACD, Williams indicators, these are examples of automation. What they are doing is they are automating, taking the math on this thing, on this chart, and plugging it into a formula. That's the whole point of an indicator. The indicator can be used to build signals. The signals can be used to build strategies, and the strategies can be used to better inform a plan. And what we can do is we can test those strategies. We can test those plans on paper. But that gets a little bit repetitive at some point. What we want is we want the ability to tell the computer to test that strategy for us. Or we want the computer to give the computer the ability to take what's in our mind with regards to this trend line and plug it into a formula and have it spit out what it is that we want to see. We want to have the computer do the automation of the analysis for us instead of having to do all the analysis with our eyes. Automate the analysis. And that becomes part of the plan. Part of the plan is automate the analysis, automate the backtesting, automate the strategy. Let's look at how we can automate a strategy. Previously, we've been working in TradingView, and we've been sort of ignoring this little panel right here, which comes right on down and just kind of hides itself down there. But if you click on the Pine editor down here at the bottom, it will bring up this nice view right here. And what this is this is an editor to a formula that is going to run on every candle. So what we're going to do is we're going to come in here on these candles, and we're going to say, on this candle, we're going to run this formula, whatever this formula is. Whatever this formula does on this candle, well, that's what we're going to do at this time frame. And we're going to do it here in our chart. And then on the next candle, we're going to run this formula again. And then again and again and again and again and again. Every single candle gets the formula run on it. And the output of that formula is how we draw the indicator. So let's see how that actually plays out. I've got a untitled script here, and this is the formula for how scripts begin. It starts by saying what kind of script we're going to make. This is a study. A study takes a formula and applies it to every candle in order to study the chart. And what we've done is we've said, I'm going to name this. What's it called? Oh, who knows? Trade the plan. Okay. Now, what I've said here is I've said that this is a string literal. I have to enclose string literals in quotation marks. That's the format. So we're just going to be glossing over, so I want to cover this really quick. We're going to be glossing over some of the formats, some of the ways in which these things work, and I'm going to be sort of dropping clues into how these things are composed and you can think about them. I can't possibly teach you how to program in an hour. What I can teach you is how to think about programming, how to think about taking a formula and applying it to every candle, and taking the output of that formula and applying it to your chart. That's how you want to think about it. I can tell you how to think about breaking down your strategy into components, if then else, and then break those individual components down into their individual constituent parts. And that's what we're going to do, except we're going to do it for real this time. And I'm going to show you how to think about automating your portfolio and how to think about automating your strategies. And then what I invite you to do is go read. Go study the tutorials. Go study the TradingView wiki. Go study other people's indicators. You can come in here and pull up somebody's indicators and then click on this and see the code. You can actually see what the code is doing. Study tutorials. Study YouTubers who do this for a living. This is what they do, is they create indicators. Study how to create strategies that I have taught you how to create, and then study how to automate those strategies. Real briefly, this is a string literal. Anytime that we have a string of characters, it's called, which is just, some bunch of characters that we want to put into the system, we have to denote that this is not, some special keyword or something. This is just something I'm making up. And so whenever I just make up a string of characters, I have to put them in quotes like this. And then I'm going to invoke the study function, and I'm going to pass this in to the study function. So we can think about this as invoking something that does something, and then passing this to that something as the value of what we want to operate on. In this case, what we're saying is I want to make a study of every chart, of every candle, every single candle. and I want to call that study trade the plan. Okay, that's just the way that Pine script works. That's what this is called, Pine. Okay, then we have another function which has it's called plot. And the nice thing about, Pine this is when you actually mouse over it, it will tell you how to invoke it. It says plot, which is a built-in annotation function, and it plots a series of data on the chart. Well, that sounds useful. And you can see that we can pass in a series and a title and a color and a line width. So let's try some of those, right? We're going to pass in a series, and we're going to pass in the close, which is this right here on a red candle, or it's this right here on a green candle. So let's plot the close against our chart. Close is a built-in variable, and it's the current close price. This is what I'm saying is I can't teach you all the built-in variables. What I can teach you is that you need to call the right function and pass in the right value. If you want to plot something, if you want to do a study and you want to call it trade the plan, then you call study trade the plan. You want to plot something and you want to plot the close, you call plot and you pass in close. Then what you need to go do is look up, control click, all the built-in variables. Here's close, there's open, there's high, here's open right here, here's high, there's low, here's the built-in functions. All the help is readily available for you here, and there's lots and lots and lots of, and here's the operators. There's lots and lots and lots of tutorials online. Go and study the tutorials. What we're going to do is we're going to breeze through a couple of these in order to give you an idea of how these work, and you're going to have to go and study them on your own. Let's see what plotting the close looks like. When I add it to the chart, what it does is it adds a new indicator, and it plots, predictably, the close, which pretty much matches our candle chart. We're just looking at the candles, except we're only looking at the close. Now, let's say that we wanted to do something a little bit more interesting, okay? Besides just redrawing the chart. Let's say that we wanted to see the range that we were moving within, right? Instead of saying let's plot the close, let's instead plot the size of the candle, right? How big the candle is, because that's actually a little bit more interesting. I would say that this indicator would tell us, this indicator would get high and spiky when we have, larger candles, and it would get small and low when we have candles which are when you have candles which are small. But what that indicator would do is it would basically ignore the price. We would only be looking at the size of the candle. So how would we do that? Well, what we would do is we would say that, the candle size is equal to the high minus the low. Okay? And then what we would do is we would plot the candle size. Let's get rid of this guy, and then we'll add it to the chart. And look at that. Pretty nice, actually. Let's make that a little bit, let's make that a little bit cleaner so we can see it better. There we go. Beautiful. What we're looking at here is when the candles get big, our indicator gets spiky. And when the candles go small, our indicator gets flat. Nice. This is a nice indicator because it's actually telling us something useful, which is when the market is in times of volatility versus when the market is rather flatlined. But what's nice about this is we're also ignoring price, right? So what we can do is we can say, aha, this spiky right here, this volatility was comparable to this volatility over here, but it was not nearly as significant as this volatility right here. This was some really spiky volatility. Okay. Coming back here, we can say that we got these spikes right here, which are making these spikes right here, and that this spike right here was comparable in its downward and upward motion to this one right here in terms of the average size of the candle compared to this, which is correct. Look at that right there. That's about the same size as that. Really a useful indicator because just glancing at the indicator, I can see all kinds of additional information. Now, let's try something a little bit more advanced. Let's try what's called an oscillator. So let's study an oscillator for just 1 second. The technical momentum indicator invented by the technical analyst Chande is created by calculating the difference between the sum of all recent gains and the sum of all recent losses, and then dividing the result by the sum of all price movements over the period. Okay? It's similar to the RSI, or the stochastic oscillator, because its range is bounded between plus 100 and negative 100. So what we're saying is that the security is deemed overbought when it's over 50 and oversold when it's under 50. Okay. Sure enough. Let's try this. Calculating the difference between the sum of all recent gains and the sum of all recent losses. Let's start there. Okay. What we want to do is we want to calculate the sum of all recent gains. All right. This is our Oscillator is how you spell oscillator. The idea here is that we are going to I lost my place. Where'd it go? There we go. The idea here is we're going to pull up my Chandler. There we go. Gonna calculate. First thing we need to do is we need to know the recent gains, the sum of all recent gains, and the sum of all recent losses. So a gain is described as being where the open is greater than the close. Okay? That's how we decide what a gain is. But what we want to do is we want to calculate the sum of all recent gains. So if we only did this operation right here, this would only compare our current candle, because remember that this is running on every single candle. So our open and our close is for our current candle. What we wanted to do is we wanted to look at the sum of all recent gains and all recent losses. So we have to go back in time. Fortunately, there's a way of doing that in PineScript. Here's how it works. What we do is we say we want to go back in time 10 bars. So we're going to define a variable. This is a variable. It stores our values for us. And we're going to say that length, GTH, length, let me not be lazy with my naming conventions, length is equal to 10. Length being equal to 10 is how far back we're going to look. We haven't told it that yet. We're just assigning a variable length and we're saying its value is 10. Okay? Then what we want to do is we want to use a built-in operator for summing things. Summing will take the following. Again, if we mouse over this, we can pull it up. The sum function returns the sliding sum of the last y values of x, where you take the source and the length and it returns the series. And it returns the sum of x for y bars back. So if you type in x and x, then y bars back. Okay, so x, in this case, is what we wanted the open is greater than the close. And we want to know that for the past 10 bars. Okay, this will tell us what our gains are. Because our gains are equal to the sum of the opens being greater than the closes over the past 10 bars. Equally, the other side of that coin is, of course, our losses, which is, as we know, the sum of the opens being less than the closes. 10 bars back. Well, we don't want to keep repeating so this is the point, is I don't want to have to keep repeating this magic number 10. If I want to change the length back, I don't want to change it in 2 different locations here. What I want to do is I want to change it in 1 location. So I can substitute my variable 10 length, which is equal to 10. And now, if I want to change the length that I'm looking back on my gains and my losses, I can change that in 1 place. I can change it here, and now I'm looking back 13. Now I'm summing back 13 instead of 10. 13 times where the candles were, you know, the gain, or the gains were versus the losses. Okay, so what this is going to do, what we're going to do now is we're going to say our oscillator is equal to, let's see, coming back to our oscillator, the description was that we took the recent gains, the sum of all the recent gains and the sum of all the recent losses, and then divided the result by the sum of the price movement over the period. Okay, the sum of all price movement over the period. Well, that's easy to compute. That would be gains minus losses divided by gains plus losses. Or, as it said, taking the sum of all recent gains and the sum of all recent losses and dividing it by the total motion over the market. Okay. Then what we want to do is we want to multiply that by 100 to give us a percentage. Finally, what we want to do is we want to show this. So what we've done is we've computed the sum of our gains, sum of our losses, divided that by the motion over the total of the motion. Here's the total of the motion right here. Sum of the gains, sum of the losses, divided by the total of the motion over the market. Let's plot that. Add a chart. Sorry, I need to change my version here. Doesn't like it when I do that. There we go. Mixing old code with new. What we've done here is we've shown an actual oscillator over a 100% range. And we can see that when our price gets nice and spiky, we move above the 50 line. And when our price gets nice and spiky, or gets real low here, we move down below the 50 line right here. So this is our oversold, and this is our overbought. Excuse me, other way around. No, it is right. That was right. Is overbought. No, overbought, and this is oversold. Yeah. Coming down, we've done too much selling here, and did I get this backwards? This sure looks backwards to me. Yeah, I feel like I got this backwards. Sure looks like it. Oh, no, because it's summed out. That's why. Okay. No, because what's happening here is we're looking for the sum of the, we have to look over the past 10, right? We have to look over the previous sums to see what direction we're actually moving in, right? So when this thing is moving downward, what we're seeing is that we're seeing a lot of price action against the trend. That's what we're seeing right here, right? Is we're seeing that the amount of gains and losses is very much proportionate to the total market motion. That's this. It's approaching. We're approaching at this point. We're approaching 100% of the market motion. This right here, and then this right here. And as that motion occurs, we move into our 100% range of that market motion across the 10 past bars. Or 13, I said. Let's do 20 and see how it changes. Okay. We can see that when we move this out to a 20, the indicator becomes a lot less useful as an oscillator because it's no longer measuring the up-down motion. The whole point of an oscillator is to measure the up-down motion. So let's try this back at 10, which is the original recommendation, and compare that one final time. Finally, we get the view that we were really looking for. Here, we are really measuring very, very close to, to a good portion of a good 75% of our up-down motion right here. Here, we're getting only to 50% of our up-down motion. You can see that the oscillator tells you when you move within a range, when you move on an oscillation. All right, let's try one that you're probably more familiar with. Let's actually make the MACD. Okay. Remember that the MACD consists of two signals, two RSIs effectively, a slow and a fast. So we'll do the fast, and we'll say that's 12, and we'll do the slow, and we'll say that's 26. Now what we need is our moving average, and we agreed earlier that this was a exponential moving average, so it needs to decay over time. Fortunately, as you can imagine, TradingView and PineScript have moving averages the same way that they have summing window functions. So let's do that. We want to do the fast moving average is equal to the EMA of the close against the fast, and the slow MA is equal to the EMA of the close against the slow time frame. Again, what we're doing is we're looking backwards in these time frames. We're taking the exponentially weighted moving average. Simple moving average function returns an exponentially weighted moving average. In EMA, weighting factor decreases exponentially. So, as we go further back in time, the weights of our values become less and less important in our series. And now we have what we need to show our EMA. Okay. Of course, our moving average convergence divergence is, as we know, the fast MA minus the slow MA. We have a, let's plot that. There we go. Okay. If we wanted to plot the individuals, what we could do is we could plot the, so this is the histogram, effectively. This is the moving average convergence divergence, right? And if we wanted to see the actual fast and slow lines against the moving average convergence divergence, we could do that too. we could say plot fast MA, and then let's make that a different color. And plot the slow MA, and let's make that a different color. We'll make that red because we already have something that's blue. We'll get rid of some of these guys here. Why did those not turn color? I'm not clear. Those should have changed different colors, and now I don't know why. A little confusing. Ah, well, we can change it here, can't we? Okay. Here you can see our fast trend quickly crossing our slow trend, and here is the moving average convergence divergence. You can see here that we have we're at the 0 line on our moving average convergence divergence, and here we're getting lots of divergence. Here's back to convergence, here's divergence, and back to convergence all around the 0 line. See the 0 line right here? This is where we go negative and positive. So this is above, this is convergence above, and this is convergence below. Or this is divergence above, and that's divergence below. Okay. Finally, what we want to do is we want to plot. Okay, so the whole point of having this, the whole point of having control over our indicators is we want to be able to signal when these things occur, when we have a moving average convergence divergence and a crossing. So what we might do on something like that is we might take the simple moving average of the moving average convergence divergence over a 9 period, and let's plot that and see what that looks like. Okay, and we'll get rid of this, and we'll modify this. Make that green, make that red. Sorry for changing the colors up on you. Make that blue, make that purple. Nice and rainbowy. Okay, and let's get rid of these things. And we'll just take a look at our signal line. So what we're doing is we're plotting our moving average convergence divergence, the amount of convergence and divergence, against a simple moving average of the convergence divergence. And what we're saying is we're saying the same thing. When we cross, when the signal line crosses over the MACD line, that is our indicator. Okay. And again, we'll make this easier to see. We'll close this out. We'll make this easier to see. There we go. And suddenly we have our nice, clean, moving average convergence divergence indicator built from scratch. This is the signal line crossing over the trend line right here. Beautiful. Now, the whole point of all of this is that we want to do something clever like automate it. Okay? The whole point of automating is that we want to be able to, in an automated way, see if this really is a good time to sell. See if this really is a good time to buy. Okay? So let's just use a very fundamental strategy, and then what we can do is later, at a later time or on your own, you can explore how to converge these strategies with the idea, these studies with the idea of a strategy. So let's just use a very simple one. In this particular market, we might have made market if we had taken an open position above 8,000 Satoshis and then closed it when it went below 8,000 Satoshis. This would be the most simple idea because what we're doing is we're using the price as our indicator. Other times we might use the signal line crossing over the MACD line. MACD, signal being greater than MACD and then being less than MACD, or signal being less than MACD and then being greater than MACD. Okay. But let's just do the start. Let's just do the basic example so we can see how studies turn into strategies. Here I'm going to make a strategy. I need, version 2 for this? So confusing. No rhyme or reason to this. You just gotta go in there and find out what's what with you know, what version works and everything. This is our buy low, sell high strategy is what this is, right? And we're gonna say if the close is greater than 0.00008, the close is greater than 0.008, then what I'm going to do is I'm going to say strategy dot entry I'm going to buy. I'm going to say I'm going to take a long position with 10 coins, and but I only want to do this when my strategy position size is less than or equal to 0. Otherwise, what I want to do is I want to sell, but only, this would be a short, but only when my strategy size is greater than 0. Okay, what I'm saying here is that if I remember I'm executing this for each and every candle. So I'm coming in here and I'm saying, well, was the close of this candle greater than 0.008? If so, buy. But only buy when my position size is 0. Means I haven't bought yet. Otherwise, I'm going to buy 10. Otherwise, what I want to do is I want to sell. And then what we can do is we can do something clever, like plot the strategy dot equity at that time. Let's see if we did this right. Right. What did I screw up? Why does it not like that? Oh, I think it's probably because I'm telling you, version 2 is just whack. I never did quite get the hang of it. Let's stare at this for just 1 second here. This is strange. Add chart. Well, this is the demo gods curse right here is what this is. Order limits 2,000 was reached. Okay. So let's move this to a 1 week chart. So I really want to show this working. Here we go. Well, it didn't work exactly how I wanted it to. It's got issues. However, I'm going to move forward as if it didn't. The idea here, and I'm not quite clear on what it is I'm doing wrong, except to say, yeah, I'm really not clear on what it is I'm doing wrong. The idea here is that what you would do is you would tell it when to buy and when to sell, based upon the conditionals. Remember earlier when we made our strategy, we said, if this is true, if the Williams indicator is here, if the RSI is above, if MACD Williams, if this, if that, I'm going to sell. Conversely, if these other situations are also true, I am going to buy. Now, the idea here is that what the strategy has done for us is it has, under normal circumstances, not this crazy talk clown shoes that's happening, and because I'm cursed by the demo gods, what's normally happening is that the strategy is tracking your profitability. It's saying, okay, if you bought here and then you sold here, how much money would you have made? And then if you sold here and then you bought here, how much money would you have made? Okay. Now what you can do is you can come over here to the strategy tester. And assuming that we're not doing a total clown shoes demo, which we are today, what it would do is it would compute your buy and hold return against your actual net profit. It would compute how many winning trades you had made, how many losing trades you had made, and your percentage profitable. And then you could tell you what your average trade was, and once you got this right, you could see here that this would be really valuable, because what would happen is you would go, oh yeah, no, this strategy was working really well right here. And it would visually tell you that right here I bought, and right here I sold, and then right here I bought, and then right here I sold, and maybe your strategy isn't working so well anymore. At which point you come back here and you do what it is I need to do now and debug your strategy. Come in here and modify your strategy. Test your strategy. But don't just test it with your eyes. Take your strategy, build it out here, figure out, take somebody, okay, this is the real part I want to get across to you, is you don't have to do this work. This is the real part I really want to get across to you. You don't have to do all of this work, okay? There are strategies here. Here is a Bollinger Band plus RSI double strategy by Chart Art. Okay, you can take his strategy, come in here and mess that up apparently. Somehow I failed to do that. There we go. Come over here, take his strategy, click on show the source code. Then you can come down here and start looking at what it is he did. What did he do? He computed an RSI. He computed Bollinger Bands. Then he made his strategy. What is his strategy? Got to come in here and look at what it is that these functions are going to do for us. And then crossover. And crossover, we're looking for a Bollinger Band that's crossing and an RSI that's crossing at the same time. And if that's true, then we're going to go long. And otherwise, we're not. And if we are overbought on the RSI, and we're crossing under on the Bollinger Band, then we're going to sell. Long, short, if we are oversold on our RSI and we are crossing over our Bollinger Band, go long. If we are undersold on our RSI and we are overbought on, if we are crossing under on our Bollinger Band, go short, sell. Now, let's take this and do this. And assuming that this isn't, again, total clown shoes, which it is, what you should be able to do is add it to your chart, and then let's try a different one because this one doesn't seem to be working. The way to find a strategy is that it has these little up-down arrows next to it. And some of these are fantastic. For some reason, I'm not able to bring up actually test this strategy for some reason, and I'm not quite sure why. But usually what you do is you just do what it is I showed you, and then you push the button and it works. Right. So easy. Let me try one more here before I move on from this. There we go. This one worked. Finally. Let's kill this thing. Come in here and take a look at the source real quick. What did we do? We got our inputs, our fast length, our slow length, signal length, very slow length, a couple of switches, which is enable a couple of things that we can control from our inputs. We did our calculations to get our fast MA or our slow MA. We're probably going to do some sort of MACD. Sure enough, you've seen this code before. It should be familiar at this point. Making our colors in order to make things pretty, and doing some plots against our MACD. Finally, here's the strategy itself. If the candle long, strategy, we're going to cancel, right? If we are crossing over our histogram, and our MACD is greater than 0, and our fast-moving average is greater than our slow-moving average, and the close of our slow length is greater than, at our slow length is greater than our very slow-moving average, then enter a long. Now let's see that play out. Number one, we can see it play out in the charts. Here we went long. Here we went short. Let's move this to a slightly better time frame, like a 6-hour time frame. Not so much. We'll stick with the 1 week time frame. Okay, here we went long, here we went short. Here we went long. What did we actually do in reality? Let's find out. This is what we actually did in reality. The list of trades that we would have traded if we were following this strategy. Okay? This is the performance summary. Our buy and hold return would have been 2,169% over this period. Our percent profitable using this strategy would have been 43%. This strategy sucks, is what you just found out. But it sucks only on this market and on this time frame. And on a different time frame and on a different market, this strategy might perform awesome. Well, say you like a Bollinger Band strategy. Say you like a simple moving average strategy. Say you want to find out how that strategy is performing in a market. Well, come find out. Understand what the strategy is. Break down the strategy into its components, into its constituent parts. And if you need help doing that, find somebody else who has already done it. Come in here, and if you like an RSI strategy, find an RSI strategy. Study it. Here's an RSI strategy. Let's study it. what are we doing? It's a long one, right? Got our inputs. No, sorry, let me just make sure that I'm actually there. It's not a long one. Thank you. So much better. This is what I was expecting to see. Length of 14, length of 30, length of 70. I'm sorry, 14, 30, and 70 is our length, and we're going to input that. It's going to be something that we're allowed to input, and what we can do is, because we're accepting it as an input, we can come here and modify it. If we want to test a different length for our overbought signal, we can change that to 65, and then when we test our strategy, which doesn't seem to be signaling at the moment, but when we test our strategy, we can then modify, come in here and say, let's try a length of 7 and see how that works. Let's try a length of 14. Let's try all these different variables. Let's try and figure out what indicator is going to perform the best in this market against what time frame. Test the different strategies. Don't just go into a market with a strategy, trade the strategy, and then find out that you were going to lose money. That's avoidable. That's entirely avoidable. Come in here and make the strategy work for you on paper. Make the strategy good. Make the strategy great. Well, here it is finally. It had gone overbought and then oversold. This probably needs a much shorter time frame. There we go. Hey, all right. Let's take a look. Buy and hold return hasn't changed. This strategy still sucks, but we could probably make it better. Maybe on a 4-hour time frame we can get some better results. Yeah, we're already creeping up the percent profitable. 3-hour time frame. 6-hour time frame. 4-hour time frames seem to be a sweet spot, but we're still not hitting it quite right. Maybe this market just sucks. Maybe we need to go BTC USDT. Okay. Well, that's not so bad. It's not always going to work, and this is what you needed to find out. Is what was working here. You bought here, and you took the short, and then you took the long. Maybe it was working back here for you. Maybe it was performing really well. And then what happened is the market conditions changed. And the strategy that was working well for you for months suddenly had you shorting right here. And then this happened. The strategy was okay right here. Look at this. We had a long position right here. And then it took you short. No good. Find out on paper first. Build your strategy. Test it. Automate the testing. Then automate the strategy. Once you have figured out that the strategy really is going to work for you, plan the trade, trade the plan. And that's the way of the trader. Thank you very much.